If you're watching this and you're somewhere in your 50s, first of all, good for you. Seriously. A lot of people your age are either too stressed about money to even look at this stuff, or they've convinced themselves that it's somehow too late to make any meaningful financial moves. And I want to start by telling you right now, that is absolutely not true. In fact, I'd argue that your 50s might be one of the most powerful financial decades of your life, if you play it right. You've got experience, you've got perspective, and in most cases, you're at or near your peak earning years. The question is, what do you do with all of that? We're going to walk through exactly that today, step by step, backed by research, and in plain English. No jargon, no fluff. Just the stuff that actually matters. According to a 2023 Federal Reserve survey of consumer finances, Americans aged 55 to 64 have a median retirement account balance of just $185,000, but the mean is over $537,000, which tells us the gap between those who plan and those who don't is enormous. That gap, that's the opportunity, and you're here, so you're already ahead of most people. Chapter 1. Understanding where you actually stand. Before we talk about where to put your money, we need to talk about where your money is right now. This sounds obvious, but you'd be surprised how many people in their 50s have a vague, foggy idea of their financial picture, and vague doesn't get you to retirement. So the first thing I want you to do is a financial audit. That just means getting clear on 3 numbers: what you own, what you owe, and what you earn versus what you spend. We're talking about assets, liabilities, and cash flow. Your net worth is simply everything you own minus everything you owe. Write it down. Your home equity, your retirement accounts, your savings, any investment accounts, those go on the asset side. Your mortgage balance, car loans, credit card debt, any other debt, those go on the liability side. Subtract one from the other. That's your starting line. Research published in the Journal of Financial Planning found that individuals who regularly calculated and tracked their net worth accumulated significantly more wealth over time than those who didn't, not because tracking magically creates money, but because awareness drives better decisions. Now, here's where the 50s get interesting. You've likely spent the last 2 to 3 decades building equity in your home, making contributions to a 401k or pension, maybe raising kids. Your 50s are often the decade where all of that starts to compound visibly. The math starts working in your favor in a big way, but only if you don't let lifestyle inflation eat all of it. Here's one of the most underused financial tools available to people over 50, and it's literally written into U.S. tax law: catch-up contributions. Once you turn 50, the IRS allows you to contribute more to your retirement accounts than younger investors. In 2024, you can put up to $30,500 into a 401k. That's $7,500 more than the standard limit of $23,000. And for IRAs, you can contribute an extra $1,000 on top of the standard $7,000 limit, bringing your total to $8,000 per year. Fidelity Investments research shows that savers who maximized catch-up contributions in their 50s ended up with retirement balances that were on average 25 to 30% higher than those who didn't, assuming the same investment returns. That's not a small difference. That's potentially hundreds of thousands of dollars, and it's available to you right now. If you're not already taking advantage of catch-up contributions, that's job number 1. Chapter 2. Rethinking your investment strategy. Okay, now let's talk about actually investing the money, because this is where a lot of people in their 50s get tripped up. They've heard the old rule that says as you get older, you should move everything into bonds and be conservative. And while there's some truth buried in that advice, the blanket version of it is outdated, and honestly, it could cost you. The traditional rule of thumb used to be subtract your age from 110, and that's the percentage of your portfolio that should be in stocks. So if you're 55, you'd have about 55% in stocks and 45% in bonds. But here's the problem with that math in today's world. People are living a lot longer. The Social Security Administration reports that a 65-year-old man today can expect to live on average until age 84. A 65-year-old woman can expect to reach nearly 87, and roughly 1 in 24 people who reach 65 will live past 90. That means if you retire at 65, you could need your money to last 20 to 25 years or more. If your portfolio is too conservative in your 50s, you risk something called sequence of returns risk combined with longevity risk. In plain English, your money might run out before you do. Most modern financial advisors now suggest a more nuanced approach, one that keeps a meaningful portion in growth-oriented investments well into your 60s and even 70s, while building in protection for the short term. One framework that research consistently supports is called the bucket strategy, popularized by financial planner Harold Evansky. The idea is simple. Divide your money into 3 buckets based on when you'll need it. Bucket 1. Cash and short-term, 1 to 2 years of living expenses in a high-yield savings account or money market fund. This is your peace of mind money. It means you never have to sell investments at a bad time just to pay your bills. Bucket 2, medium-term. Money you won't need for 3 to 10 years goes here. This can be a mix of bonds, dividend-paying stocks, and balanced funds. Lower volatility, but still growing. Bucket 3. Long-term growth. Money you won't touch for 10-plus years. This stays in growth-oriented assets. Index funds, equities, real estate investment trusts. This is your inflation fighter. A landmark study by Morningstar found that retirees using a bucket strategy experienced significantly lower financial anxiety and made fewer panic-driven investment decisions during market downturns, which, as any financial researcher will tell you, is one of the biggest predictors of long-term portfolio success. The bucket strategy works because it separates your emotional brain from your investment brain. When the market drops 20%, you're not panicking because you know bucket 1 has your next 2 years covered. You can let bucket 3 ride. Speaking of where to put money, let's address one of the most well-supported findings in all of investment research. Most actively managed funds underperform simple, low-cost index funds over the long run. The S&P Dow Jones SPIVA report, which tracks the performance of actively managed funds against their benchmarks, consistently finds that over any 15-year period, roughly 88 to 92% of actively managed U.S. equity funds underperform the S&P 500 index. Year after year, the data is remarkably consistent. What that means for you is a simple 3-fund portfolio, a total U.S. stock market index fund, an international index fund, and a bond index fund has historically beaten the majority of professional managers, and it does it with lower fees, which is money that stays in your pocket. If you haven't already, look into funds from providers like Vanguard, Fidelity, or Schwab. Their index funds have expense ratios as low as 0.03%. That's basically free. Compare that to actively managed funds that often charge 1% or more, and over 20 years, the compounding difference is staggering. Chapter 3. Real estate, side income, and other assets. Stocks and bonds are not the only tools in your kit. Especially in your 50s, when you may have built up home equity and have skills or assets you've accumulated over decades, there are other wealth-building levers worth pulling. If you own a home, you're already in real estate investing. The question is whether you're maximizing that asset. A few things worth considering. First, if you've got significant equity in your home and you're planning to downsize in retirement, that equity can be reinvested. Selling a $600,000 home and buying a $350,000 property frees up $250,000, and depending on how long you've lived there, you may be able to take advantage of the capital gains exclusion of up to $500,000 for married couples filing jointly. Second, rental income. If you have a spare bedroom or a basement unit, renting it out can generate consistent income that supplements your retirement funds. Even a modest $1,000 per month in rental income adds $12,000 a year to your bottom line, and that's $12,000 less you're drawing from your investment portfolio. According to the Urban Land Institute, real estate has historically provided total returns of 9 to 12% per year when you factor in both appreciation and rental income, competitive with equities and with the added bonus of physical asset backing. If you want real estate exposure without actually managing a property, real estate investment trusts, or REITs, are worth knowing about. REITs are companies that own income-producing real estate, and by law, they're required to pay out at least 90% of their taxable income as dividends. That means you get regular income, diversification into real estate, and liquidity, because REITs trade on stock exchanges just like any other stock. You can add REIT exposure through a REIT index fund, which is even simpler. Here's something the finance textbooks don't talk about enough. You, at 50-something, have accumulated decades of skills, relationships, and expertise. That is an asset, and in many cases, it's monetizable in ways that younger people simply can't access yet. Consulting in your field, freelancing, coaching, teaching, these are not backup plans. For many people in their 50s, a side income of even $1,000 to $3,000 per month can dramatically reduce the pressure on their investment portfolio and allow it to keep growing untouched. Research from the Stanford Center on Longevity found that people who remained engaged in meaningful paid work past 60, even part-time, reported higher levels of financial security, life satisfaction, and cognitive health compared to those who made a hard stop at retirement age. That's not an argument against retirement, it's an argument for intentional transition, moving toward work that energizes you rather than just stopping entirely. Chapter 4. The big risks to watch out for. Now, I need to spend some time on the things that can undo all of this good work, because in your 50s, the stakes are high. You don't have 30 years to recover from a major financial mistake the way a 25-year-old does. So let's talk about the big risks and how to manage them. This is the risk that haunts every retiree and pre-retiree. Here's how it works. If you experience a major market downturn in the first few years of retirement and you're drawing down your portfolio at the same time, the combination can be devastating. Even if markets fully recover years later, you've sold shares at low prices to fund your living expenses, and those shares don't come back. A 2020 paper in the Journal of Financial Economics demonstrated that two investors with identical lifetime returns but different return sequences can end up with vastly different retirement outcomes, with the unlucky sequence resulting in portfolio depletion decades earlier. The bucket strategy we talked about earlier is one of the best defenses against this. Having 1 to 2 years of cash on hand means you never have to sell equities during a downturn. You live off bucket 1 while bucket 3 recovers. A lot of people in their 50s think about protecting their money, and they equate protection with safety, so they put everything in cash or CDs. And while that feels safe, it's actually quietly dangerous because of inflation. The Bureau of Labor Statistics data shows that at a 3% annual inflation rate, which is close to the historical average, the purchasing power of a dollar is cut roughly in half over 24 years. So if you retire at 62 and live to 86, prices will have roughly doubled. A safe pile of cash that isn't growing is actually shrinking in real terms every single year. This is why you need growth assets, even in retirement. Treasury inflation-protected securities, or TIPS, are one tool specifically designed to keep pace with inflation. Dividend-growing stocks are another. Companies that consistently raise their dividends tend to outpace inflation over time. And, of course, real assets, like real estate and commodities, have historically provided solid inflation hedges. This one is non-negotiable. Healthcare is the single largest wildcard in retirement financial planning, and the data is frankly alarming for people who aren't prepared for it. Fidelity's annual retiree healthcare cost estimate projects that a 65-year-old couple retiring today will need approximately $315,000 saved specifically for healthcare costs in retirement. And that's on top of Medicare premiums, which many people don't realize aren't free. If you're in your 50s and you have access to a health savings account, or HSA, through a high-deductible health plan, this should be a priority. An HSA gives you a triple tax advantage. Contributions go in pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. After age 65, you can withdraw for any reason, paying only income tax, making it essentially a second IRA. Max it out if you can. In 2024, the contribution limit for a family is $8,300. Over 10 years, that's over $83,000 earmarked specifically for one of your biggest retirement expenses. Chapter 5, Social Security. Don't leave money on the table. We can't wrap up a conversation about investing in your 50s without talking about Social Security, because the decisions you make here could easily be worth six figures over the course of your retirement. The big question everyone faces is, when do you claim? You can start as early as age 62, but your benefit is permanently reduced by as much as 30% compared to your full retirement age benefit. On the other hand, for every year you delay past full retirement age, which is 67 for most people today, your benefit increases by 8%, up until age 70. An analysis by the Center for Retirement Research at Boston College found that the majority of Americans claim Social Security earlier than is financially optimal, often leaving $100,000 or more in lifetime benefits uncollected. The math generally favors delaying if you're in good health and have other income to cover your expenses in your early 60s. An 8% guaranteed annual increase is extraordinarily hard to beat in any investment market. If you can delay to 70, your monthly check will be about 77% higher than if you had claimed at 62. Of course, this isn't one size fits all. If you have health issues or you desperately need the income, claiming earlier makes sense. But if you have the flexibility to wait, even to 67 or 68 rather than 70, the cumulative benefit is significant. Chapter 6, the mindset shift that changes everything. I want to close with something that might be the most important thing I say today, and it doesn't involve a single financial product or tax code. It's about mindset. The biggest financial risk for people in their 50s isn't a bad investment or a market crash. It's inaction driven by anxiety. It's the paralysis that comes from looking at your retirement account and thinking, I haven't saved enough, so what's even the point of trying now? A 2022 study published in the Journal of Economic Psychology found that financial anxiety, specifically the feeling that it's too late to improve one's situation, was one of the strongest predictors of continued poor financial behavior. In other words, the belief that you're behind creates a self-fulfilling prophecy. The people who believe they could still improve their position, even in their 50s, consistently outperformed those who didn't, regardless of starting balance. So here's the reality check. Even if you're starting from zero at 55, maxing out your catch-up contributions for 15 years while earning a modest 7% average return puts you at over $500,000 by age 70. Not a dynasty, but an absolutely livable and dignified retirement. And if you have something already, even $50,000 or $100,000, the math gets better fast. The science is clear. The best time to plant a tree was 20 years ago. The second best time is today. And in investing, unlike gardening, the trees from today can actually grow as fast as the ones planted decades ago, because compound interest doesn't care how old you are when you start. It only cares that you do. Okay, let's land the plane. Here's your action plan in order of priority. Do a financial audit this week. Know your net worth, your monthly cash flow, and your current retirement account balances. Start or increase catch-up contributions to your 401k and IRA immediately if you're not already maxed out. Open or maximize an HSA if you're eligible. It's one of the most tax-efficient accounts available to you. Build your investment strategy around simplicity, low-cost index funds, a sensible asset allocation, and the bucket strategy for peace of mind. Think carefully about Social Security timing. Every year you delay past 62 can meaningfully increase your lifetime benefit. Don't abandon growth. Inflation is real, and you may live longer than you think. Keep growth assets in your portfolio. Consider your human capital. Part-time income in your 60s can be one of the most powerful tools you have. That's it. 7 steps. None of them require a financial genius. They just require you to show up, be consistent, and believe that the math still works in your favor, because it does. If you found this useful, share it with someone you know who's in their 50s and stressing about money, and drop a comment below. I read every single one. I'll see you in the next one.